For beginners, understanding derivatives might seem daunting, but with the right approach, they can become an important part of a diversified investment strategy. This guide breaks down the basics of derivatives, explains how they function, and explores the various types and their practical uses. What are derivatives? At their core, derivatives are contracts whose value is tied to the performance of an underlying asset. This underlying asset can be anything from company stocks and government bonds to commodities like oil or gold, or even more abstract financial measures such as interest rates or market indices. The value of the derivative fluctuates based on the price movements of the underlying asset. Imagine a scenario where you agree with a friend to buy their car 3 months from now for a fixed price. You've essentially created a derivative contract. The value of that contract will change depending on what happens to car prices during those 3 months. In finance, derivatives formalize such agreements into contracts that can be traded on markets. How do derivatives work? Derivatives function by creating an agreement between two parties, the buyer, long position, and the seller, short position. The terms of this agreement specify how the value of the derivative will react to changes in the price of the underlying asset. For example, if the underlying asset's price increases, the buyer of the derivative might profit, while the seller incurs a loss. Conversely, if the price decreases, the seller benefits, while the buyer loses money. This zero-sum nature of derivatives means that for every dollar gained by one party, another loses an equivalent amount. While this may seem risky, derivatives are designed to manage risk effectively when used correctly. Derivatives come in several forms, each serving unique purposes. Here's an overview of the primary types. 1. Forward contracts. A forward contract is a customized agreement between two parties to buy or sell an asset at a specified price on a future date. These contracts are not standardized and are traded over the counter, OTC, meaning they are private agreements not regulated by an exchange. For instance, imagine a coffee farmer agreeing with a buyer to sell a future harvest at today's prices. This contract helps both parties hedge against future price fluctuations. 2. Futures contracts. Futures contracts are standardized versions of forward contracts traded on regulated exchanges. They specify the quantity, quality, and delivery date of the underlying asset, making them easier to trade than forwards. For example, an airline might use oil futures to lock in fuel prices for the next year, ensuring stable operating costs despite volatile oil markets. 3. Options contracts. Options give the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price on or before a specific date. They come in two types: call options, grant the right to buy the underlying asset; put options, grant the right to sell the underlying asset. For instance, an investor might purchase a call option on a stock if they expect its price to rise, profiting from the price increase without committing to owning the stock outright. 4. Swaps. Swaps are agreements between two parties to exchange cash flows or financial instruments. The most common types are interest rate swaps and currency swaps, used primarily by institutions to manage risks associated with changes in interest rates or currency values. For example, a company with a loan at a variable interest rate might use an interest rate swap to exchange it for a fixed rate, reducing uncertainty in future payments. But why would you invest in derivatives? Hedging risk. One of the primary purposes of derivatives is risk management. Businesses and investors use derivatives to hedge against unfavorable price movements. For instance, farmers use commodity futures to lock in crop prices. Exporters use currency derivatives to protect against exchange rate fluctuations. By stabilizing prices or returns, derivatives reduce uncertainty and help companies focus on their core operations. Speculation. While derivatives can mitigate risk, they also attract speculators looking to profit from market movements. A trader might use options to bet on a stock's price increase without needing significant upfront capital. However, speculation can amplify both gains and losses, making it a high-risk strategy. Leverage. Derivatives allow investors to control large positions with relatively small amounts of money. This leverage can magnify returns on successful trades, but it also increases the potential for significant losses. Market efficiency. Derivatives contribute to market efficiency by allowing investors to express their views on price movements, liquidity, and volatility. This helps in price discovery and ensures that markets function smoothly. Practical examples of derivative use: airlines and fuel hedging. Airlines are among the most prominent users of derivatives. Given that fuel costs can make up a significant portion of an airline's expenses, they often use futures contracts to lock in fuel prices. This protects them from price spikes and helps maintain predictable operating budgets. Farmers and crop prices. Farmers face uncertainties around crop prices due to weather, pests, and global market conditions. By entering into forward contracts, they can sell their produce at a predetermined price, ensuring stable income regardless of market fluctuations. Investors and portfolio insurance. Investors use derivatives like put options to protect their portfolios from market downturns. For example, purchasing a put option on a stock index can offset losses in a broader market decline, acting as a form of insurance. Advantages and risks of derivatives. Advantages. Risk management. Derivatives provide tools to hedge against unfavorable price movements. Leverage allows investors to gain significant exposure with minimal capital. Flexibility. Derivatives cater to various investment strategies, from hedging to speculation. Liquidity. Many derivatives, especially those traded on exchanges, are highly liquid, allowing easy entry and exit. Risks. Complexity. The intricate nature of derivatives can lead to misunderstandings and mismanagement. Leverage risks. While leverage amplifies gains, it also magnifies losses, potentially wiping out investments. Counterparty risk. In OTC derivatives, the other party might default on their obligations. Market volatility. Derivatives are sensitive to rapid market changes, increasing the potential for significant losses. For beginners, entering the derivatives market requires a cautious and informed approach. Understand the basics. Familiarize yourself with derivative types and how they function. Set clear goals. Determine whether you're using derivatives for hedging, speculation, or another purpose. Start small. Begin with standardized products like futures or options on regulated exchanges. Educate yourself. Utilize resources like books, online courses, or professional advice to deepen your understanding. Monitor your investments. Keep track of market conditions and the performance of your derivatives. Derivatives are powerful financial tools that offer opportunities for managing risk, leveraging investments, and participating in sophisticated market strategies. While they can enhance returns, they also come with significant risks, especially for those unfamiliar with their complexities. By understanding the fundamentals, using them responsibly, and staying informed, you can make derivatives a valuable part of your investment portfolio. Whether you're an individual investor or a business looking to hedge risks, derivatives provide versatility and depth in today's financial landscape. Thanks for joining me on this journey into the world of derivatives. Don't forget to like, subscribe, and share this video for more insights into investing. Until next time, happy investing.